Hello and welcome to Chapter 4. We are beginning the fourth week of our course. So this is our fourth WebEx session. Just a couple of housekeeping items. So where are we in the course? Going to course content. All of you should have by now completed the orientation module. We are still in Module 1. That date has to be updated, obviously, because we are on the 29th in week 4. Each module, as you know, has 4 weeks worth of content. Week 1, 2, 3, and 4 are located within Module 1. In week 4, which is where we are now, that means we've already completed the Chapter 1 quiz from week 1, the Chapter 2 homework assignment and Cengage, the Chapter 3 quiz that was due this past Sunday, and now we're in Chapter 4. This week we have a discussion board, so it's a little bit lighter this week, which is kind of nice, right? But don't get too excited about that because the content for the week is not that easy. What you've already gone through in the past 3 weeks, we've been walking through the accounting cycle, especially in weeks 2 and 3. In week 4, we're completing the accounting cycle, going through the final steps, and we're going to bring it all back together. In accounting, as you know, everything is driven by steps. Everything's a process. Of course, yeah, there's formulas and there's numbers and things like that, but that's not really what we're concerned about. We're more concerned about understanding the concepts, right? So let's jump into Chapter 4, which is where we're at right now, and we will go through the process. So as you get into Chapter 4, if you come down to the instructional materials folder, and then go ahead and access the PowerPoint. PowerPoint opens up. I shortened this up a little bit just because I wanted to make sure that we end by 7. We'll probably end before then, but I think officially we're supposed to go like 6:50. So sometimes we run a little bit over, and I understand again, these sessions are optional. So if you have to drop off for whatever reason, I totally understand. Just remember, what's due during the week and what your responsibilities are, and remember that these sessions are all recorded. So if you ever need to come back and rewatch something, you didn't understand something, you could watch the video, pause it, rewind it, whatever. So, and of course, anytime that you have questions, comments, or concerns, you can always email me. You can schedule some time to meet with me during office hours. I'm here for you. Okay, so Chapter 4, completing the accounting cycle. So, this looks a little muddy, right? So let's walk through it. Toward the end of at the end of the accounting period, and we learned a little bit about this in Chapter 3, we want to perform what's called an adjusted trial balance. Okay, an adjusted trial balance. What that is, it is a way for us to recognize any adjusting entries that we have made or need to make at the end of the accounting period, which in this case is at the end of the year. The adjusting entries that we commonly make, as you know, have to deal with accounts receivable, inventory, insurance that's been prepaid, depreciation, wages payable, unearned rent, fees earned, rent revenue, and we also have to affect the expenses on the other side of that, right? So at the end of the accounting cycle, we need to reconcile everything. And in the last chapter, we talked about bank reconciling. And in this chapter, we're talking more about that account reconciling. So looking at this graphic, on the top part, as you can see from lines 8 through 18, these are our balance sheet accounts. cash, accounts receivable, supplies, prepaid insurance, land, office equipment, so forth and so on, right? All the way down to common stock. All of those, as you know, are balance sheet accounts. We've got our assets on top, we have our liabilities, and our equity. At the end of the accounting period, we make our adjusting entries, and some of those accounts we're going to be impacting, especially accounts receivable, supplies, prepaid insurance, accumulated depreciation, and wages payable. So we make our adjusting entries, and as you can see, it gets transferred to the balance sheet, and those adjusting entries are noted. And then, of course, I need to make any adjustments to our dividends, which, as you know, dividends are found on the retained earnings statement. So we take our net income that we generated from the bottom of our income statement, subtract out our dividends, and that gives us our net or change in retained earnings. And then we have our revenue and expense accounts and any adjustments that we needed to make there. For example, fees earned, rent revenue, wages expense, supplies expense, insurance expense, depreciation expense. And those adjustments are reflected in the income statement. So this just kind of shows you how the data flows, Now, looking at that spreadsheet that I just showed you, beginning with the unadjusted trial balance, the reason why we would perform an unadjusted trial balance is to verify that the totals of the debits equal the credits. As you know, the accounting equation is assets equals liabilities plus equity. Your transactions impact two accounts. Every transaction impacts two accounts. That transaction is always in balance. Your debits always equal your credits. Whatever account you're debiting must equal the account that you're crediting. For example, if I am making an adjustment to my prepaid insurance and transferring that to insurance expense, at the end of the accounting cycle, the transaction I make is I'm going to debit my insurance expense account to increase my insurance expense. I'm going to credit my prepaid insurance account to decrease that account. Does it make sense? Yes, maybe. Hopefully. Yes? Good. Thank you, Bertie. Miss Harris, I appreciate that. It's nice to hear your voice. I'm glad you're here. So every transaction, you have a debit and a credit. Those debits and credits must always be equal. The same concept applies when we make our adjusting entries. The example I just gave you about increasing your insurance expense and decreasing your prepaid insurance to recognize that we've consumed that insurance, that transaction must always be in balance. The debits must always equal the credits. And that is the concept behind the unadjusted trial balance, is that we run this report to verify that we have not made any errors. If we see that the debits do not equal the credits, we know there's a problem and we need to adjust it. Okay. So let's take a look. Adjustments are normally entered in the order of which the data is assembled. What do I mean by that? Okay. In the order the data is assembled. If the title of the accounts are adjusted and not appear in the adjusted trial balance, accounts are inserted in the proper order of the title column. Okay, so let's take a look back here at how it all flows together. Earlier on, in earlier chapters, we talked about how the income statement, balance sheet, statement of cash flows, retained earnings, how they're all related. Okay. When I'm making a report, I start off with my balance sheet accounts, then I do my retained earnings, and then I do my income statement accounts. The reason why it flows in this order is because the balances must be derived from the retained earnings, which, as you know, comes from the income statement. So look at this. Look at this. As you know, in accounting, the first thing we do is we make our journal entries. Our journal entries reflect the transactions that we're entering into our accounting system. For every sale that I make, for every piece of inventory I purchase, or for every expense that I enter, every bill that I enter, I need to make a journal entry. And when I do that, I'm building up my income statement. When I build up my income statement, at the end of my month, right, I have net income. My revenues minus all of my expenses for that month give me net income. That net income then gets transposed or moved over to the retained earnings statement net income line, because at the end of that year, I close out my temporary accounts. And when I close my temporary accounts, I move my net income over to retained earnings. Now, here's the other interesting thing. My retained earnings beginning of the year, plus or minus the change in net income, minus any dividends I paid, gets me to the change in retained earnings, which ultimately equals the new ending balance of retained earnings. And that amount gets transposed onto the balance sheet under stockholder equity. So this is the process by which I close out the end of the accounting period, or the end of the year. And so looking back at where things naturally occur, we start with the income statement. End of the income statement gets transposed to the retained earnings. Retained earnings gets transposed onto the balance sheet. That's the connection. And so
Professor,
through the
I'm sorry.
process,
I'm sorry to disturb you. I'm hearing a whole lot of feedback and I can't hear you.
I got you. No problem. Thank you, Angela.
Thank you, sir.
Absolutely. So through the process, we're able to close out the accounts for the end of the accounting period. On that report that I just showed you, the adjustments columns verifies the debt, the debits equal the credits for those adjusting entries. And those two must always be equal. Okay. Now, let's talk a little bit more about this. The adjustments in that report that I just showed you are added or subtracted to the amounts of the unadjusted trial balance to arrive at the same column amounts. What does that mean? So looking back, you can see here at the bottom in line 29. This might be a little harder for some of you to see. It's kind of small, but line 29, those are our totals, right? And you see how the columns are laid out. In that first part, it says unadjusted trial balance. We can see that our debits and our credits equal 42,600, 42,600. We can see that our adjusting entries that we made throughout the year and at the end of the year are also equal, 2,360, for debits, 2,360 for credits. Then we can see that our total adjusted trial balance also equals 43,400, 43,400. So we can see that all of this is it balances, right? And that's what we want. Our unadjusted trial balance should our debits and credits should equal. Our adjustments that we've made throughout the year should be equal, debits and credits. Our adjusted trial balance should equal debits and credits. The whole point here is to help us to identify any errors that may have been made and to make those adjustments accordingly. That's the whole concept behind it. That's why I thought it was really important that I showed you that. Okay, so this slide just basically tells us the layout. Lines 20 through 28 are on the income statement. Dividends are line 19. 8 through 18 are the liability accounts, so forth and so on. It's basically just a breakdown of what it looks like. Okay, so again, the one thing that connects the income statement to the retained earnings to the balance sheet is that net income. At the end of each year, your net income gets zeroed out, or your income statement gets zeroed out. We call revenues and expenses temporary accounts. At the end of every single year, we close those out and we start the next year with zero. Because we can't carry over revenue and expenses. That doesn't make any sense. You wouldn't want to carry over revenue or expenses because it will show an improper reflection of your revenue and expenses for that next year. You don't want to go into a new year with stuff on your books, as they say. So what do? You close it out through the closing process. We take our net income amount, we transfer it to the retained earnings account from net income minus dividends, gives us our change, which is our retained earnings. The retained earnings gets transferred to our balance sheet, and then we start the new year fresh. By taking that net income and transferring it to the retained earnings and to the balance sheet, we start off the new year with zero balance. The only area that you will have a balance in the new year is, of course, going to be in your retained earnings and on your balance sheet. Those are permanent accounts. Those always stay with you. Always stay with the business. Okay. As you know, on the income statement, you have your revenue and your expenses. And then at the bottom, you have net income. Revenue minus cost of goods sold if it's a merchandise business equals gross profit minus expenses equals net income. Right? The income statement is prepared directly from the adjusted trial balance columns with the end with that report. It begins with fees earned. The expenses and the income statement are listed in order of size. Order of size. So what is size? Size is the amount of the expense for each line item. And then, of course, miscellaneous is always listed at the bottom, regardless of how much is in miscellaneous. It's just the way the report structure is. And it's pretty straightforward. Retained earnings statement. As you know, a retained earnings statement shows the net income from that period. Well, there's a beginning balance retained earnings if the business was in operation for the previous year, plus or minus the net income for that year, minus any dividends that you pay out, equals your retained earnings. And the retained earnings gets transferred to the balance sheet. On the balance sheet, as you know, the balance sheet shows your assets, your liabilities, and your equity in the same exact way that the accounting equation is. Assets equals liabilities plus equity. Balance sheet's prepared directly from the adjusted trial balance at the end of the year. The assets and the liability accounts are taken from that spread from that report. The retained earnings amount is taken from the retained earnings statement. balance sheet shows a subtraction of assets and liabilities on the classified balance sheet. Assets are commonly divided into two sections, as you know. You have current assets and long-term assets. Current and long-term. Current and long-term. This is also known as current, and I've seen it called permanent, current, and property, plant, and equipment. Current assets include things like cash, accounts receivable, inventory, any other receivables. Those are current assets. Current means within 12 months. Then you have long-term. Long-term, as you know, is more than 12 months, greater than 12 months. That would be property, plant, and equipment. Property, plant, and equipment, these are physical things, okay? Property is the property that the building sits on. Plant is the building itself. Equipment are things like pieces of machinery. A dump truck, for example, is a piece of equipment. A set of tools that could be equipment. Equipment is large pieces of equipment that help you to create inventory, right? Through the process of manufacturing. That's equipment. Or equipment could also be an office printer that's $1,000 or more, right? Or a couple of computers. That's equipment. Then, of course, you have liabilities. Liabilities are also broken out into two sections. You have current liabilities and long-term liabilities. Current liabilities is what you owe to someone else within 12 months. Okay, what you owe to someone else within 12 months. Example would be accounts payable. That's where all of those bills that you receive every month, that's where you enter those into, right? You might have wages payable. That's monies that you owe to your employees for work that they've already performed. You might have current portion of long-term debt. That is the 12 months of a long-term debt that you owe within that 12 months. Those are current liabilities. Anything owed within 12 months, that's current liabilities. Then you have long-term liabilities. These would include things like a mortgage, a car loan that is greater than 12 months. It would include things like long-term loans, long-term bonds, those types of things. So let's break it down a little bit further on the balance sheet. I had mentioned that we had current assets, property, plant, equipment for assets, and liabilities has current liabilities and long-term liabilities. Let's break it down a little bit further. Current assets, as you know, are things that be used within 1 year, 12 months or less, 12 months or less. That's current. For assets, as you know, assets that are current include cash, notes receivable, accounts receivable, supplies, which is also known as inventory, and other prepaid expenses, such as prepaid insurance. The reason why prepaid insurance is listed as a current asset is because you can always cancel that policy and take that cash back, okay? Or it hasn't happened yet, therefore it's still an asset for you. Another way of thinking about it. Notes receivable, this is when we have a customer, okay? This customer has been having trouble paying us for the past 90 days. And I sent notice after notice after notice. The customer hasn't paid us. So what do you do in that type of situation? Well, you reach out to that customer and you say, hey, listen, I know you're having trouble paying, and that's okay, I'll work with you. What I'll do is I'm going to convert your accounts payable into a notes payable. Okay? And so what does that mean? The customer agrees to terms. They say, okay, listen, I'll pay you within 90 days. I'll pay you at this interest rate, and that'll resolve that customer's account, right? To get them up to current. And so it creates what's called a notes receivable for the company. A notes receivable acts as like a short-term loan with that customer that was behind paying you. Does it make sense? Angela? Does it make sense? Kevin?
Yes.
Okay, great. Okay, now let's dissect property, plant, and equipment a little bit further. Property, plant, and equipment, also called fixed assets or plant assets. As you know, in accounting, some terms mean the same exact thing. Sometimes companies call something else that means the same thing. Like, for example, I might say property, plant, and equipment. You might say fixed assets. Okay, it doesn't matter. It's just terminology. But property, plant, and equipment, which is also known as fixed assets, I don't really use plant assets that much, but these include things like the land that the building sits on and the assets like the equipment, the building, and the machinery. Buildings, machinery, and equipment, those things depreciate over time. What is depreciation? Can anyone tell me? What is depreciation? What is that?
It loses value.
Yes. Kevin, did you want to add to that?
Yeah, I can add. It's when you have an asset that loses value over time.
Exactly. Yeah, it loses value over time. That's right. Thank you. Yeah, so an example would be a dump truck. Okay, a dump truck is a piece of equipment that I use in my construction business. Okay, the dump truck cost me $25,000. This is an example I'm giving. That I purchased a dump truck for $25,000. Its useful life is 5 years. The IRS tells me I could get 5 good years out of that dump truck. Okay? The dump truck will lose value over that 5 years because I'm using it, right? It's depreciating, it's getting worn out, it's losing its useful life. Okay? So every year for those 5 years, I will depreciate that dump truck for $5,000 per year for the 5 years until it reaches a value of 0. We call that straight line depreciation. Good example? What do you think? Keandre, was that a good example? He says yes. Okay.
I'm sorry, I was in the middle of eating. Yes.
Thank you. All right, cool. All right, now let's dissect current liabilities a little bit further. These are amounts that the business owes to its creditors. So, if I get a bill in the mail for my electric, and it's for power that I consumed last month. Okay, I got my electric bill. It's for 30 days. It was for the month of September. I get that in the middle of October. I'll pay it a few days later or a few weeks later. I put that bill into accounts payable. I debit my utilities expense and I credit accounts payable. Okay. It's a bill I received, but I have not yet paid. That's accounts payable. Current liabilities are things that you need to pay within 12 months or less. These include things like notes payable, accounts payable, wages payable, interest payable, taxes payable, unearned fees. Accounts payable, it's a bill I received but I have not yet paid. Okay. Notes payable, that's a short-term loan that I have received the cash for that I need to pay back within 12 months or less. Wages payable, That's when I owe my employees money, but I haven't paid them yet for the work that they've already performed. Remember, in business we usually run about 2 weeks behind. You work to 2 weeks, 2 weeks later I pay you for that 2 weeks. Then another 2 weeks, I pay you for that 2 weeks. 2 weeks, I will pay you for that 2 weeks. Every time I do that, I generate a wages payable. Interest payable, if I took out a loan, I owe interest on that loan, right? It's different from notes payable. I separate the two. The reason why I separate the two is because interest is not a component of the loan. They're separate items. The loan is the face value or principal balance of the loan. That's the note payable. The interest payable is the amount of interest that I owe from that loan. But they're two separate items, you see? That's why I have interest payable separate from notes payable. Taxes payable, when I pay my employees, I need to pay taxes. When I make a sale of a good or service, I need to pay sales tax. When I pay my employees, I need to pay wage taxes like federal income tax, state income tax, state unemployment taxes, and then of course Medicare and Social Security. Those are taxes the owner the business pays. You pay the same. You pay them too from your payroll, but the business also pays those. And of course, unearned fees. Unearned fees. This is where you perform the service. Like let's say you own a landscaping business. Okay, you mowed the lawns, but your customers I'm sorry. Let me think about this. Unearned fees. This is where the customer paid you up front for the service, but you haven't done it yet. For example, you own a landscaping business. The customer says, hey, listen, I'm going to pay you for the whole year up front, but you haven't mowed those lawns yet. You haven't mowed those lawns yet for that year. It's classified as unearned fees. It becomes earned when you mow the lawn. Does it make sense? Yes. Good. Wonderful. Thank you.
Yeah, it makes sense.
All right. Thank you, Kayvon. Appreciate it. Okay, cool. Now, what about the long-term liabilities? These are loans that are greater than 1 year, like a mortgage or, a long-term loan, more than a year. We expect it to pay for 30 years, 20 years, like student loans, for example. That's long-term. Stockholder equity. Stockholder equity is the owner's rights to the business. What do I mean by this? Stockholder equity, think of it as the difference between the assets and the liabilities. The accounting equation can be rewritten, but still be in balance. What do I mean by that? We have assets equals liabilities plus equity. That's the accounting equation. That's the accounting equation that everyone knows. You can rewrite that equation and it could still be in balance. Assets plus liabilities equals equity. Or assets minus liabilities equals equity, plus or minus. The accounting equation is still in balance. Equity is what the owners own. What they own. It's the rights to the business. So this is, to calculate owner's equity, we add the total of liabilities, and it must be equal to the total of the assets. Equity. Okay. Now earlier, I talked about temporary accounts and permanent accounts. Temporary accounts are accounts that get closed out at the end of the accounting cycle, end of the accounting year. Permanent accounts They stay with the business from year to year. Permanent accounts are permanent. It doesn't matter what happens throughout the year, but I'm still going to have a cash balance. It doesn't matter what happens throughout the year. From year to year, I'm still going to have inventory. I'm still going to have accounts receivable. I'm still going to have accounts payable. I'm still going to have these liabilities. Okay? On the balance, think of it this way. The balance sheet accounts, the accounts that are on the balance sheet, those are permanent accounts. They don't go anywhere. On December 31st, on January 1st, those accounts are still there. They don't go anywhere. They don't get zeroed out. I don't close my bank account every single year. That'd be ridiculous. I keep it open, okay? And I just make sure that my balance equals what I have on my bank statement, right? By reconciling, as we learned in the previous chapter. Those are permanent accounts on the balance sheet. Temporary accounts are the ones that are on the income statement because we close those out at the end of every single year. We zero them out. I don't start the new year with revenue and expenses already there. How is that possible? It's not possible. So I close those out. Those are temporary accounts. So again, temporary accounts are on the income statement. They get closed out at the end of every single year because they only relate to that specific time period. Revenues and expenses can only be recorded, and remember, this goes back to the earlier principles you learned about in the first two chapters. Remember the matching principle we talked about? You need to match the revenues and expenses at the time that they actually happened. And so I cannot carry over those accounts to the next accounting period. It doesn't work that way. They're temporary. So I close them out at the end of every single year. And I close those out through the retained earnings statement. Okay, what's a closing entry? Let's talk about the closing process. At the beginning of the new year, so on January 1st of this coming year, I should have zeros on my income statement. I should have zeros. I'm not going to start with revenues and expenses. I close those out at the end of every single year. To achieve this, what I need to do is I transfer those revenues and expenses to my retained earnings statement through closing entries at the end of the accounting period. Closing entries are the entries that transfer those balances. The transfer process of taking it from the income statement to the retained earnings statement is called the closing process. And once in a while they we always call it closing the books. That's like the street lingo of the closing process, closing the books. Yeah, I'm closing the books. That means I can't record any additional revenue and expenses for that year because I'm closing that year out through the closing process. I'm closing the books. After the closing entries are posted, I close out all of my revenues, close out all of my expenses, and those accounts go back to zero because I transferred those account balances to the retained earnings statement through the net income. So how do you do it? Well, it's a 4-step process. Step 1, your revenue account balances are transferred to an account called income summary. So how do I do it? Of course, I'm going to make the debit in credit, right? Same with the, so for revenue, I'm going to debit my revenue accounts and credit income summary. For my expenses, I'm going to debit income summary and credit my expenses. I'm going to take my income summary amounts and transfer that to retained earnings. How am I going to do that? I'm going to debit retained earnings, credit income summary to transfer that over. The balance sheet of the dividends account is transferred to the retained earnings. So here's how it looks graphically. I take all of my revenues and my expenses. I'm transferring all that through the income summary onto my retained earnings account, and I subtract out any dividends. Income summary, what is it? It's a temporary account that we only use during the closing process. At the beginning of the closing process, income summary has no balance. During the closing process, revenue and expense accounts are cleared by debiting or crediting the income summary for their amounts. We call it clearing the account. Because this has an effect of clearing the revenue and expenses, the income summary is sometimes called a clearing account. Okay. There are 4 closing entries that I just discussed a little bit earlier. I debit the revenue accounts and credit the income summary. I credit the expense accounts and debit income summary. By doing that, I'm clearing out the revenue and I'm clearing out the expenses. I'm zeroing it out, right? By transferring it to this temporary account called income summary. I then debit the income summary account for its balance and credit retained earnings to transfer it to retained earnings. Sometimes it's the opposite if there's a loss. Hopefully there's not a loss. And then the 4th entry is I debit retained earnings and I credit the dividends account. That transfers it over, right? And that's how it gets onto the balance sheet. Does it make sense? Are there any questions on that closing process at all?
No.
Ms. Harris, are you good?
I'm good.
Wonderful, thank you. Cool. Okay. Here's a nice flow chart of how it looks. I'm not really into flow charts. Some of you might be into flow charts. I'm really not. I just don't get a lot out of them. And this is kind of a visual representation of those steps that we just talked about. So I'm not going to spend too much time on this. I'm not one for flow charts. I'm sorry. It doesn't work for me. This is a list of the closing entries that we made. So again, kind of a visual representation. We take all of our revenue accounts and we credit those to income summary. We debit all of our expenses. We credit all of our expenses and we debit our income summary. That closes out those accounts. We take our income summary, we credit retained earnings to transfer it to retained earnings. And then the last thing we do is we take our retained earnings and we credit to our dividends to move it into the dividends account. Just kind of a nice graphical representation of what all that looks like. As you can see, there's a ton of transactions that have happened throughout the year. So don't get too concerned with this slide. To me, it's a little too busy. But it just kind of shows you nice graphical representation of the closing process. So post-closing. Post-closing trial balance is prepared after the closing entries have been posted. The purpose of this is to ensure, again, that your debits equal your credits. The trial balance is to verify that the ledger in the balance at the beginning of the next period. So here's what a post-closing trial balance looks like. As you can see, we have our assets, our liabilities, and our equity. It's always in the same order, right? Assets, liabilities, equity. Our assets equal $29,545. Our liabilities and equity equal $29,545. We're in balance. We're good. Okay. Remember, assets equals liabilities plus equity. Assets equals liabilities plus equity. That's the accounting formula. That's the very basic element of everything in accounting is that formula. Okay, so the accounting cycle. You heard me talk about this throughout the past couple of chapters. So the accounting cycle is a process that begins with analyzing and journalizing transactions. That's when you're entering all those transactions in, and it ends with the post-closing trial balance. We just basically went through the entire accounting cycle. So the accounting cycle is a total of 10 steps. And the 10 steps happen throughout the year. At the beginning of the year through the end of the year, I'm entering transactions, I'm analyzing them and recording them in the general journal entries. That's step 1. Step 2 is I'm posting them to my general ledgers. Step 3, I make any adjustments. I prepare an unadjusted trial balance before I prepare the adjustments. Step 4, I look at what needs to be adjusted. Step 5 is an optional end of period spreadsheet. I never do step 5. I'm just saying, I never do it. It's just kind of a waste of time. Step 6, I make my adjusting entries through journal entries and I post them to the respective ledgers. Step 7 is the unadjusted trial balance. Step 8 is the financial statements that I generate at the end of the accounting period or at the end of the year. I call those my final statements for the year, but that's just my way of calling it. Step 9, I make any closing entries. I make all my closing entries to zero out my income statement for the beginning of the next year. In step 10, I prepare a post-closing trial balance to ensure that my debits equal my credits, my assets equals my liabilities plus equity. Here's a nice visual representation of what that looks like. In chapter 1, you learned about how to enter transactions through the how to journalize them, how to record them, right? How to analyze them. And in chapter 1, you learned about the accounting equation, assets equals liabilities plus equity. In chapter 2, you learned how the transactions are posted to the general ledger accounts. And we had a nice discussion around that. We talked about the rules of debits and credits, what holds normal balances. You remember that part, I'm sure. You know, that assets normally carry a debit balance, liabilities normally carry a credit balance, equity normally carries a credit balance. You know, we talked all about that good stuff. Dividends normally carry a debit balance. Revenue normally carries credit. Expenses normally carry a debit balance. And we talked that was step 2. And then in step 3, which was the end of chapter 2, we went through the unadjusted trial balance process. And then the last chapter, which was chapter 3, the one we just went through before this chapter, is what we made our adjusting entries. We talked about adjusting entries, what the impact is, how they're assembled and analyzed. We talked about the optional end of year spreadsheet, which I never do. It's kind of, I don't know, it's kind of redundant in my opinion. Step 6, the adjusting entries are, we journalize them, we make our adjusting entries to the journals. Step 7, we adjusted the trial balance. We made the adjusted trial balance, right? And that brought us to our current chapter, chapter 4, where we analyze the adjusted trial balance, we assemble our financial statements, we make our closing entries to close out our temporary accounts, which are on our income statement, through the journal entries. Again, that's the process by which we take our income and our revenue, we allocate those to income summary, income summary to retained earnings to dividends. That's that process we just talked about. That's step 9. Then step 10, we created a post-closing trial balance to verify that our accounting equation and our debits and credits still equal. And that is the foundation of accounting. That's the accounting cycle. Every year we go through that cycle. And it's very systematic these days. You know, it's not like what it used to be. Most places that I go to, or if I'm asked to do any consulting for small businesses, they're not using Excel. Okay, they're using QuickBooks, or they're using Sage 50, or they're using Peachtree, or they're using some type of accounting software. Okay, they're not using Excel. Excel's nice. Okay, don't get me wrong. It's a very powerful piece of software, but when it comes to managing revenue and expenses and trying to understand where your business is at, it takes so much time to use Excel. That's why I personally, for my businesses that I do consulting with, I use QuickBooks. I love QuickBooks. It's easy, it's user-friendly. And for those of you who are on the call, and for those of you who own your own businesses, I know some of you do, and we've talked, I recommend that you use QuickBooks or some type of accounting software to track your revenue and expenses. And don't worry, these days, a lot of stuff is free now. So, I mean, please use it. It's to your benefit. Okay, so how does it look, right? How does the accounting cycle look from a perspective? This is an example, Kelly Consulting. As you know, in business, we have the chart of accounts, we make our journal entries, we prepare our adjusted trial balance, we do the spreadsheet maybe. We enter our adjusting entries, we create the adjusting trial balance, we create our financial statements, we enter our closing entries, we create our post-closing trial balance, and then we look at our ledger to verify that everything balances. The chart of accounts, as you recall from the first 2 chapters, the chart of accounts is a list of all of the accounts that the business operates within. And it's in order. It's always in order. It starts with the balance sheet. It ends with the income statement. On your balance sheet, you have listed out, you have your assets, then your liabilities, and then your equity accounts. And then on your income statement, you have your revenue, your fees earned, and then you have all of your expenses listed out. So this is just an example of a chart of accounts for this company, Kelly Consulting. The company throughout the year makes their journal entries. As you know, journal entries are the transactions that have taken place throughout that respective year or throughout that respective month. I do it every single month. In fact, I do journal entries every single week. Right? And busier businesses, you know, like a Fortune 500 or, you know, a large corporation, they do journal entries every minute. Yeah. But don't think that accounting is all boring, right? It's not just data entry. It's not just you know, this mind-numbing stuff. Because nowadays everything's so automated. The computer has really started to automate a lot of processes. So it makes accounting a lot easier. That's why I recommend things like QuickBooks and these other accounting softwares, because it really does make things easier.
Professor,
Keandre.
I actually did want to speak to you about that, especially in this field. If you are pursuing like the finance field, how do you think most of the positions will be outsourced by like technology, or do you?
No, not at all. And I'm glad. Thank you so much for bringing that up, Keandre, because this is an important thing to talk about. So no, I do not believe that accounting will ever be outsourced by technology. I do not think that automation is the death of the industry. I do not think that. What I think is happening in the industry, actually what I know is happening in the industry, is that automation is helping the human aspect of things. Now, think of it this way, Keandre. Can a computer decipher emotion? What do you think?
No,
No,
not yet.
not yet, and I don't think it ever will. Can a computer make judgments? I don't think it can.
No. It's just what we input to do, or
Yeah, exactly. Because a computer does not have emotional intelligence, a computer cannot pass judgment. A computer has the inability to carry other aspects that only a human can. For those reasons, the answer is no.
I
Automation
think you
will
still have
not
to
be able to do
factor in human error too when you look at that.
That's also true. That's also true, Joan. And to go along what you're saying, Joan, when we make mistakes when we're entering the data, hopefully the computer catches on based off of the parameters that we put into place. But if the parameters are faulty, it might not catch it. So going back to what Keandre is saying, and this goes along with what Joan just said, is that identifying human emotion, identifying that computers cannot make judgments, identifying other human aspects that only humans can do? The answer is no. I don't think automation will kill the industry or take over the industry. What I do think is that it will help the accountants become more focused on what they do best, and that's analyzing, that's making judgment, that is presenting that human aspect. So good question, and I think that helps it. So Keandre, if you want to do some more research on that, it's called RPA, Robotic Process Automation.
Okay, I'll definitely look into it because I've been kind of researching about like technology and stuff and like that. So they were like, oh, most jobs will be outsourced by computer and technology, but
Well,
it's
not
like
true.
50-50.
Yeah, not true. My belief is that RPA or robotic process automation will assist the humans in becoming better at their job. I don't think it's designed to be a replacement mechanism, but that's my opinion. And but I really believe that is true. And based off of all the research I've read, that's probably the case. I do not think that we'll be replaced by computers at any time in the future. Definitely not in our lifetime, that's for sure. Okay, and of course, as you know, with the journal entries, we make the journal entries throughout the and every month, pretty much in every day. Then, of course, at the end of the accounting period, we prepare the unadjusted trial balance. This is where we identify the balances on our balance sheet and our income statement to ensure that our debits and our credits are balanced. This is that end of period spreadsheet that I never create, but it's basically a way of identifying your unadjusted and your adjustments and your adjusted trial balance together to ensure that your debits and credits remain in balance. And your unadjusted is before your adjusting entries. Then the middle part here is your adjusting entries, and at the end is your adjusted trial balance. This is what it looks like after you've made the adjusting entries. And as you can see, it's all in balance. The adjusting entries that we typically make, as you know, those are accounts like insurance expense, the prepaid insurance. This is for the consumption of insurance throughout that year. Supplies expense to supplies. This is the inventory that I used in-house. Depreciation expense to accumulated depreciation. Like my dump truck example, I depreciate it $5,000 per year. So debit depreciation expense $5,000, accumulated depreciation, which is on the asset account, $5,000 to represent a reduction of that asset. Supplies expense to salaries payable. This represents that I have accrued salary and I need to pay my employee. Rent expense to prepaid rent. I am consuming the rent that I have prepaid previously. Unearned fees to fees earned. As you know, over time, I perform the service or deliver the goods to my customer, so I then recognize that I've earned those fees. Yeah. Prepare my adjusted trial balance. Again, same process, right? Your balance sheet accounts, assets, liabilities, and then of course your dividends, and then you got your income statement, fees earned, expenses. Fees earned, as you know, is revenue, right? That's revenue. So, fees earned, revenue, all your expenses, revenue minus expenses equals net income. Net income gets transferred onto your retained earnings statement. You subtract out any dividends. That gets you your retained earnings amount. Your retained earnings amount is then transposed onto your retained earnings line on the stockholders' equity. And your balance sheet is created. And of course, the closing entries, I close out all of my revenue and expenses to income summary. Income summary gets closed out to retained earnings. Retained earnings gets closed out to dividends. And the post-closing to ensure that my debits and credits are still in balance. Again, your asset accounts, your liabilities, and your equity. Does your assets equal liabilities plus equity? That answer is yes. And of course, this is just the ledger. I know it gets really muddy, right? Okay, the fiscal year. Let's talk about what kind of year. Fiscal year is not always the same as the natural calendar year. For example, our government can't manage their way out of a paper bag, but they have a different fiscal year than the calendar year. A fiscal year is a 12 months time period adopted by the business to represent the fiscal calendar. The government starts on October 1st and ends on September 30th. The calendar year, as you know, starts January 1 and ends December 31. Fiscal year is whatever 12 months that the business specifies as being its fiscal year. When I had my business, my fiscal year started on March 1st and ended on March 1st and ended on the end of February 28th, sometimes 29th if it was a leap year. It doesn't matter, what matters is that it's 12 months. That's the fiscal year, right? It can start April 1st and then March 31st. It could start on, June 1st and end on May 30th, right? It doesn't matter. As long as it's 12 months, that's the fiscal year identified by the business. A calendar year or a natural year is the calendar year. Starts January 1st and ends December 31. Corporation typically adopts a fiscal year that ends with the business activities when they reach the lowest point in operating on an annual operating cycle. They call it the fiscal year. So in other words, at the lowest point, that's the end of my fiscal year. So if I'm a seasonal business, for example, let's say I plow driveways, okay? My high points are in the winter months. My lowest points in the middle of the summer. So if I have a driveway plowing business, my fiscal year, it probably starts September 1 and it ends August 31. The reason being is because I'm at the lowest point of my year in the middle of the summer, right? That's the natural business year. So again, in most cases, businesses follow the calendar year. They start January 1 and December 31. That's in most cases. January 1, December 31, I'm working on my income statement accounts. I'm entering my transactions throughout the year. End of the year, I'm working on my balance sheet. Okay? By closing out my temporary accounts from the income statement, I go through the closing process, and I get out into my balance sheet. Then I start the new year fresh. Income statement 2017, it starts off 0 until at the end, I reach the end of that year. Then I go through the same exact process over and over and over again. And it never ends until the business is done. Okay, let's talk real quick. I know we're getting toward the end of class here. I'm sure we're probably, yeah, we're getting toward the end. All right, we're actually doing real good on time. Okay, let's talk a little bit about how do we make decisions based off of this information. It's really important that you're able to understand this accounting cycle process in order to help your business make decisions. And there's a couple of ratios that we compute in a couple of terms that I really want you to understand because it'll help you and your business. First one is liquidity. Liquidity is the company's ability to convert its current assets into cash. Liquidity is the company's ability to convert its current assets into cash. That's liquidity. Okay, current assets into cash. In other words, how quickly can I sell my inventory to convert that inventory into cash? How quickly can I receive cash from my customers that owe me money? In other words, how quickly can I convert my accounts receivable into cash? I look at these items to understand how liquid my business is. Liquidity. The next term I need you to know is called solvency. This is the company's ability to pay all of its debt. Solvency. Solvency. Is the company solvent? Solvency is a measure by which I make decisions to invest into a company. Solvency is really important for me because I need to know if my company can pay all of its debts. If I can pay all my debts, I'm happy. If I can't, there's a problem. Okay. There are a couple of measures to evaluating a company's financial health. We look at short-term liquidity and solvency to understand the company's working capital and current ratio.
I'm sorry.
That's okay.
Oh, sorry. I have a quick question.
Go ahead, Keandre.
The solvency, with businesses typically, are they able to actually pay off their debts most of the time, or do they kind of keep like a rotating balance in the sense where they can pay a good amount of it off, or?
Yeah, great question. So it depends on the size of the business and how the business operates. The answer is both. In most cases, businesses, hopefully for small businesses, they do have the ability to pay all their debts. Okay. For larger corporations, sometimes it's a matter of I can pay most of it, but not all of it. When that situation happens, I calculate a ratio. I usually calculate the current ratio to tell me how well the company is managing its debts. A classic example I can give you right now is Sears. You know Sears, right? The
Yes.
former retailer,
Yes.
right? So Sears had a solvency issue and a liquidity issue. The company could not quickly sell all of its inventory. They couldn't convert their inventory into cash quick enough. Therefore, it put a strain on its cash. Okay? The company also took on a lot of debt. the company took on so much debt that eventually it became what we call insolvent. Means they cannot pay all their debt. So they were able to pay some, but not all. Eventually, those ratios got so bad to the point where the company had to declare bankruptcy. And now, as you know, they're kind of in business, but nowhere near what they used to be. And that happens to some businesses. And that happens to a lot of big businesses that you saw recently where this happened. Neiman Marcus is the most recent one. You got Neiman Marcus, you got the Gap, you got what's that other clothing retailer, Banana Republic. You got a couple of other big names that are struggling right now. And those companies, the reason why they're struggling, because they did not effectively manage their liquidity and solvency. They did not effectively manage their business well enough to deal with these impacts. There's a lot of reasons why that happens, but to answer your question, it's kind of both. It's kind of both, and it depends on the structure of the business, and it depends on the size of the business.
And last comment. So like in cases like this, like we've never had, at least in yeah, most people's lifetime, we've never had like a situation like this. So in the company sense, when they're doing their company like health balance, making sure they can pay off things like this. So when this happened, I guess they weren't expecting it. So in situations like this is why it's good to have a good debt ratio and stuff like that.
Yes.
Okay.
Absolutely. Yeah, I couldn't agree more. And what'll happen as a result of the COVID situation and a lot of the lockdowns and the company's inability to open up to be able to sell, what you'll see will happen is that the companies will restructure. They'll look at their liquidity and solvency. They'll restructure the business. You're going to see a shrinking of the footprint of the business. Like back in the day, we used to go to the shopping mall because there was no internet. It didn't exist. Okay,
Very true.
there was no
Very true.
competition. It was the mall or nothing, right? Or a catalog, right? Some of us remember the Sears catalog. Before Sears was Sears, it used to be just the catalog. You used to be able to order a Ford car from Sears through their catalog back in the
Wow.
early 1900s and late 1800s. You could order a whole house from Sears in the 1940s through their catalog. Okay, it was a weird business back then, but it worked really well for them. They should have never have steered away and got into the clothing business. That was a terrible decision. That's ultimately, in my opinion, what killed them. But I digress. So what you'll see happen is that the American mall will go away. It will become something different. It'll become a series of small retail outlets that will act more like distribution centers. And what we saw in the news recently is that Amazon is opening 1,000 retail stores, physical retail stores across the country.
Wow.
And the reason why they're doing this is to create what the new retail industry is going to look like. Is it will be mini distribution centers, as a way of thinking about it. So in other words, what will happen is I can go on Amazon and I can get my stuff in an hour or 2 hours or within that same day. How does that happen? I can go down to the Amazon store and pick it up. In essence, it became a small distribution network, right? And so that's going to be the future of the retail industry. I can see that happening, and that's kind of already happening now, because they saw what happened, and to mitigate something like that from happening again to their business, that's the model they're going to turn to. The businesses that are affected by the COVID, they need to adjust their business model in order to survive another thing in the future, whatever that might be. So Sorry about that small tangent, but that's something that I think that's really important for you to know.
No, that was helpful. Thank you.
Absolutely. Working capital, very important formula to know. Very, very important. Working capital is current assets minus current liabilities. This tells me what is the company's ability to invest in itself. Okay, that's why I look at working capital. It tells me the company's ability to not only pay its current debt, it also tells me how can the business invest in itself, to purchase additional inventory, to make other capital improvements, right? That's what working capital tells me. Current assets minus current liabilities tells me, is a company solvent? The answer is yes. If current assets are greater than current liabilities, the company is solvent, okay? That means it can pay its current debts. That's important. It may not be able to satisfy all of its long-term debts, but as long as the company can pay all of its current debts, current assets minus current liabilities, it's okay. The rest of what it does with that working capital thereafter, it's up to the business. They can reinvest it into the business to improve the business, or they can use it to do whatever, to pay its long-term debts. Who knows? How does that computation look? Current assets minus current liabilities equals working capital. Nice and easy. What is current ratio? A current ratio is another great ratio I like to calculate when I am looking at the company's ability to pay its current debts. So the expression is we take our current assets divided by our current liabilities. And when we do that, we get a ratio. The larger the ratio, the better shape the business is in. Okay, now let's talk about reversing entries. Reversing entries happen when I need to make an adjustment on the last day of the accounting period to make a correction. We call this reversing entry. These are correcting entries. Journal entries that are recorded on the first day of the next period that reverse or opposite the related entry from the previous period. So for example, I made a mistake on a journal entry on September 30th. So the next day on October 1st, I make a reversing entry to make the correction to what happened on September 30th. Here's another example of why I would make a reversing entry. Is from accrued wages. So as you know, if my employee works every 2 weeks, I pay him. 2 weeks, I pay him. 2 weeks, I pay him. For that 2 weeks, I accrue the 2 weeks. You remember this from the last chapter. But what this is showing us is that accrual process. Now you see, I need to make a reversing entry for the last 2 days of December, because the 30th and 31st will fall on the next pay period. So that's just that, and so here's the entry I make. And in December, I make the entry: debit wage expense, credit wage payable. Then I got to make the adjustment that following month. So that following month, I make the adjustment. I got to take those 2 days out of December. I got to put them into January. So how do I do it? I debit wages payable and credit wage expense to reverse that entry. I'm reversing. Remember, it's the exact opposite of the entry you made. December 31st, I made it for those 2 days. And then the next month, I reversed it because it technically belongs to January. So this just kind of explains that process. And we made it to the end of the chapter. Yay! Are there any comments, questions, concerns that I can help to answer at this time?
One question.
Please.
Do you have classes on today's Tuesday?
Just on Tuesdays.
Oh, just on Tuesday. Okay.
Yep, just on Tuesday. Yeah, so I host the lecture on Tuesday. And of course I have my office hours on Mondays and Wednesdays. On Thursdays, I'm always available. You can always email me, right? I'm very quick to respond because it goes right to my phone, and I respond as quick as I can. Thursdays, I'm usually grading. I'm usually working on research, that type of thing. But you're more than welcome to, anytime you need me, you can pick up the phone and call me, or you can schedule a time to meet with me through office hours, or you can email me. But yeah, I only host lectures on Tuesdays because it's really online. I mean, everything that we're doing is online. Everything's already built. So it's just a matter of you going through the process. Read the chapter, watch the videos, attend the lecture, and then of course complete the homework, complete the quiz, participate in the discussion, all that good stuff. And the good news is with this particular section, it's spread out over 14 weeks. So it's not like you're bombarded with assignments every week. It's one thing to do every week. But it's just you got to keep that routine. That's the whole idea. Got to keep the routine.
Okay. Thank you.
Thank you.
Professor Dr. B, Professor B. Thank you.
My pleasure, Keandre. My pleasure. Anytime you need me, I'm here for you.
Okay.
And that goes for the rest of you, of course.
Professor, I wanted to let you know that I finally got my book today.
Hey!
So I'll be working on catching up on missed assignments.
Yeah, please do. So my recommendation to you, Joan, is I think it was and correct me if I'm wrong. I believe it was there was a quiz for chapter 1. So for chapter 1, it's just a matter of kind of review the textbook. A lot of the stuff you'll find are going to come from the PowerPoint presentation, and of course the lectures. So take the quiz for chapter 1. Homework's in chapter 2. So now that you have the book, you should have access to Cengage. Just make sure you follow the process that I outlined in the announcements to access that homework. Let me know if you have trouble accessing the homework. I'll help you out.
Okay, thanks.
Yeah, of course. Because you know how it is dealing with a bookstore. I mean, but hopefully it should be easy. And then of course you have the chapter 3 quiz, and chapter 4 is a discussion board that we just based off of the chapter we just went over. So.
Okay, thank you.
Hey, my pleasure. Thank you. Angela, are we good?
Yes, sir, we are. Thank you.
Okay, wonderful. Have a great night.
You too. Have a good night, everyone.
Thank you. Miss Harris, are you okay? Is everything okay?
Which one? Which Harris?
Wonderful.
I'm good, but there's 2 of us in here, same Harris.
Oh, there's 2 Harris. I'm so sorry. Miss Birdie Harris, are you okay? Okay, Miss Lakeisha Harris, are you okay?
Okay, it's a lot of information processing. I just have to continue watching and reading.
Exactly. Yeah, that's the name of the game. Like I said, once you get that process down, you'll be fine. It's just like anything else. The way that you learn is a process. Yeah.
Right. Yeah. All right. Thank you.
My
Have a good
pleasure.
night.
Take care.
All right then. Bye-bye.
Bye-bye. And Miss Birdie Harris, are you okay?
Can you hear me?
I can hear you now.
Okay. The same thing. I just gotta play catch up and
Okay.
looking at videos and everything. But
Wonderful.
in lesson 1, I could not balance it out. That last part of balancing everything, it gave me a fit. But I'm just gonna go back over it again.
No problem. And then if you want to, go ahead and just copy and paste that question into an email and send it to me.
I will.
I'll be happy to walk you through.
All right. Thank you.
You're so
Have a
welcome.
good night.
Thank you too. Take care.
All right. Bye-bye.
Bye-bye. And that's class. Take care, everyone. Bye-bye.